All right, 1 o'clock. Time to resume our lesson. So let's get busy. I'm going to moderate the conversation real quick and progress. And we're talking about the income approach to value. And I said I'd go over it again after the break. So remember I put all this gibberish up here on the board? Yeah, well, this is what I'm going to go over again. If you had a chance to review chapter 22 about Herb, you now understand what it is I put on the board. But if you didn't do that quick review, then you still don't know what I'm talking about. So let me go over it again to make sure everybody's on the same page. IRV, income, rate, value. Where I stands for income. Again, I'm going to do this because I got to assume that not everybody went and read that spot in chapter 22. R equals rate, and V stands for value. And once again, by looking at this diagram, IRV, and when I said before, when you look at it, I with a line and an R underneath it means I divided by R. Therefore, income divided by rate equals value. Income divided by value equals rate. And rate times value equals income. That's an X times. So those are the three formulas that you have to understand that are going to apply to the calculation of value by using an income approach to value. Again, if you don't have this basic understanding, then you're not going to understand income approach to value. So I really do hope you reviewed chapter 22, and I'm going to assume you did, so I am going to proceed. So now when we talk about the income approach to value, we have to understand what the effective gross income is, and we walk through that process, what that means. What the capitalization rate is, and that's derived by taking income and dividing it by value, and then calculating a value for property. So let's take an example. The example in the book is, and we use those numbers, so let's go ahead and just make up our own. It will work either way. I'm creating a $90,000 a year income, net operating income. The value of the building is $810,000. 810, what's a one? $1,000. So who's the first person can get up and tell me what is the capitalization rate? Let me calculate it out while you guys are calculating it out too, and give me a response in the chat room. So 90,000, sorry, calculator. 90,000 divided by 810,000 equals 11%, right? So it would be 11%, and let's forget that point, it's not there. There's no man behind that curtain. The rate would be 11%. Because you took 90,000 divided by the value and gives you a capitalization rate of 11%. Now, working these problems in reverse is, let's say 810,000 is the value times the rate times 11%. Guess what? It equals 89,100 or roughly $90,000. So it works. Not 11.1, 11%. Did anybody not understand what we're doing or how we reach that? Nicholas, we're just calculating value based on income and rates. We're not talking about write-offs or anything. I haven't even talked about that. We're just talking about market value. So Paula, you got it. Good. Anybody else? not understand how we did this? Okay, looks like we're getting it. Just want to make sure, because if I move forward and people don't get it, they're going to say, oh, but you never told us the right way to oh, guys, I'm telling you 3 times over how to do it. I'm going to have to assume then by the silence that you are all getting it. So I am going to moderate and move on. All right. So that's the income approach to value. The basic way that a appraiser is going to look at an income producing property and help determine its value. Now, there's also one other way that you're going to be tested on. There's actually 2 other ways. I'm only going to tell you about one because there's only going to be one you're going to be tested on. And that's gross rent multipliers. GRM, gross rent multiplier. So, in the case where the value, the value is $200,000 on a sold property. All right. How do I know? Because I looked in the MLS to determine it. And the monthly income, and now this is based on monthly income. So it's $200,000 value, income, gross monthly income was $1,400. How do I determine rate? Value divided by income equals rate in this case. Therefore, the gross rent multiplier of this equation is 142.86. So if I were to take the income of $1,400 times 142.86, I get a value of approximately $200,000. So that works. So now I can determine gross rent multipliers by taking value and dividing the income it produces to determine gross rent multiplier. To determine value, I would take the gross monthly rent, $1,400, right, times the gross rent multiplier of, what was it, 142.86, and get a value of 200,000. Anybody not understand how a gross monthly rent is used as a means to determine value? One more time. Okay. By using a gross rent multiplier, the number I'm interested in is the gross monthly rent that's produced by the building. How much in gross of rent before vacancies or anything is produced on a monthly basis? That's my gross rent, gross monthly rent. That's the number I want to know, because if I know the gross rent multiplier, I could take the gross monthly rent, multiply times the gross rent multiplier, determine a value of $200,000. That's how they do that. So again, I'm going to assume everybody's getting it. I hate to do that, but if there's no questions, I'm going to have to assume, no what? No, you don't get it? Another example. Okay, let's do that. So gross monthly rent on a building is $6,000. Gross monthly rent. Oops, rent. I know that the value of the building is $700,000. Again, I'm using a mouse, guys. Forgive this crap. So how do I determine a gross rent multiplier? Well, again, take the value, 700,000, divide it into the income, 600,000. So let's take our calculations. 700,000 divided by 6,000. Now I have a gross rent multiplier GRM of 116.67 for all intents and purposes. We're not going to carry it out to the 10th decimal point. Therefore, if I took the gross monthly rent of $6,000 times the gross rent multiplier of 116.67, I get a value of $700,020. That's close enough for me. I got it. So using gross monthly rent and a gross rent multiplier will help determine the value. If I don't know the gross rent multiplier, but I know another building with its income and sold price, I can determine the income and the value. I can determine the gross rent multiplier to use against this property if it's in the same geographic area, and multiply the income gross monthly rent by that GRM gross rent multiplier to determine its value. We'd be only using these formulas specific to the income approach, yes, and probably maybe only once in your life to pass an exam, unless you want to become an appraiser. So with that, I do need to move on, but was there any other questions before I move on? Always hope for the best, Jessica. Plan for the worst, hope for the best. I see a couple more questions being typed. Without a cap rate, how do you determine the value? I'm sorry, Emma? We actually went through that before lunch and just after lunch. I already went through it twice. Not a question, but this is my last day of class. I didn't, oh, you didn't? I'm sorry. Oh, that was Fabrizio. I'm sorry, Emma. I misinterpreted that. So Fabrizio, we went over it before lunch and after lunch. And I'm sure you must have read the text, so you at least were exposed to it 3 times. So what precisely is your question that you don't understand? My apologies, Emma. I don't have an ideal rate. There is no ideal rate. There is no norm. It's whatever the local market generates as a gross rent multiplier. Assuming we have a value, I don't know. I'm sorry, Fabrizio. As I said several times, I don't do well with partial questions or statements as questions. If you got a question, ask me a full question. That's all I'm asking, so I can understand it. I do want to help you, believe me, but I got to know what you're asking so I can answer it. Without a cap rate, how do you determine the value of you're trying to find the value? Oh, if you're trying to find the value. Well, as I said, Fabrizio, you would take recently sold properties of income producing quantity, show what their incomes what the income was, so that I could determine income divided by value equals capitalization rate. And if it's in the same geographic area, the same capitalization could be applied to the subject property. So again, for I don't know how many times I said it, that's how you would do it. I'm sorry, I meant GRM, John. What does the GRM get used for? Boy, I'm gonna have to stop this. Hold on, guys. Listen, I explained things at least 2 times. If you are coming into class late and want me to repeat everything I've just done for the past 14 minutes, you're actually mistaken. I'm not going to do that. Guys, you got to come back to class on time. You got to be here when we're discussing, or else you're going to miss it. And now for me to go back and explain it again, this takes away the learning opportunities of all the other students, and I can't afford to do that. I have a good number of students in class. And I do want everyone to pass the exam. But guys, you have a responsibility to be here and listen up while the class is going on. You just can't come in and say, hey, discuss this again. I'm not. Sorry. I'm going to move on. And if you don't like it, I apologize in advance. But this is the way the class gets conducted. So please come to class on time. All right, moving on. Reconciliation is the art of an appraiser who uses multiple approaches to value. He may look at a property and do a sales comparison approach. And if it produces income, he may use the income approach. He may even need to do 3 different approaches all at once for a very specific type of property. And if he can, he's going to have to reconcile his differences of values generated from 3 different approaches. They may be slightly different. In that case, his reconciliation job will be very easy. How to analyze and weigh the findings and come to some conclusion of value. If the valuations are widely different, then either he did something wrong or there's a very serious problem with his modeling. So we have to understand that just like balancing a checkbook, you have to reconcile the differences every month or so. And with an appraisal, if you're using more than one approach to value, you've got to reconcile the differences so that you can explain cohesively to your client what the conclusion of value would be. Now, appraising, the art of appraising, is conducted by appraisers. Appraisers are licensed or certified in the state where they do appraisals. There's different types of appraisers. There are fee appraisers who are for hire independent appraisers. They work for anybody and under all circumstances. Or there is a staff appraiser. A staff appraiser is usually hired by an institution to appraise its own properties or properties for its own interest. The FHA hires its own appraisers because they have a very unique way of giving certificates of value as appraisal readings. So they have to be trained in certain government forms, and they all have to be licensed if they are. So there's fee appraisers, guns for hire, anybody can work for anybody, or staff appraisers hired as an appraiser for a specific purpose or company. The CMA I was talking about before is the estimate of value that a real estate licensee gives. We can never call it an appraisal because it's not an appraisal. I'm not charging a fee. I'm voluntarily giving you a market analysis based on what I perceive your property's value to be, using the same approach as an appraiser, but again, it's not an appraisal. Apparently there's some questions out there, so go ahead. What's your questions? Priscilla and Jawung Kim, you guys have questions? I see your keyboard's open. Do property require an appraisal to sell, or can they use the CMA? Priscilla, most people use a CMA because they don't have to pay for a CMA, and a realtor is using the same approach that an appraiser does. So why pay for something you can get for free? Just saying. No, not as of now. Well, Jiwoo Kim, then please don't leave your dialogue bar open because it looks like you're asking a question. I do delay classes for questions, so. Can a CMA be given by a broker or both salesperson and broker? Whoever's doing the analysis on the property is going to be the person who generates the CMA. So yes, a broker or salesperson, once they join the MLS, will be taught how to do it. 3 chapters today. We're still on, I know. We're going to get there, James. You just hang on. It may be a quick pace, but we'll get there. Should a buyer ever get an appraisal themselves on a house? They can if they want. Michael, was there another question? It looks like the keyboard's open. And I'm going going to suggest probably maybe not. Okay, let's move on, guys. Now, what requires appraisals? Well, many different reasons: estate purposes, divorce proceedings, financing, taxes, relocation, condemnation claims, insurance losses, damage loss, feasibility studies, all require CMAs or appraisals. The appraisal process. How does an appraiser do his job? First of all, he states the problem. What's the purpose of the appraisal? So I know how to approach the data. Then list the data sources he needs, gather the information, make sure you get the verifiable data and record it and compare. Determine the highest and best use of the property. Estimate the land value, estimate the value of each of the three approaches, reconcile and estimate the value from the three approaches, and then report the final value estimate to the client and then get paid. The Uniform Residential Appraisal Report is used by many government agencies as a standardized approach to valuation. Appraisers know of this Uniform Residential Appraisal Report, and when given one, know what it means, that certain government agencies requiring a valuation of a property. It illustrates the detailed information required of an appraisal of residential property. And finally, the profession of appraising itself. Now, you can, if you want, go get your appraiser's license. However, there's schooling, there's experience requirements that you must meet. But if you do and you become an appraiser, then you can earn money as appraising. The state's top, or the nation's top appraisers, are called MAI, Masters of the Appraisal Institute. And that's a prestigious title given to well-experienced practitioners who have been doing real estate appraising and are of note. So, if any federally related transaction occurs real estate, it requires an appraisal. Any bank financing property most likely requires an appraisal. Refinancing a property requires an appraisal. Insurance loss usually requires an appraisal. Divorce proceedings, estate settlements usually require a CMA or an appraisal to the state value. So therefore, an appraisal is in demand, but must be performed by a state certified or state licensed individual. So the process of an applicant to get a appraiser's license follows this. Number one, you have to apply to go to school to learn how to be an appraiser. So you have to go to school and pass a test, just like real estate. And then you become what's called an apprentice appraiser after you prove you passed your exam and performed a minimum of 90 hours of appraisal study and pass the exam. So you become an apprentice appraiser, which means you're the low man on the totem pole and you don't really make any money yet. So in order to start making money, to become a licensed residential appraiser, you have to have 150 hours of classroom and have 2,000 hours of experience of appraising properties in no fewer than 12 months. Then if you want to proceed and become somebody of a senior or better appraiser, you have to go back to school, and to become a certified residential appraiser, you must have an associate's degree from a college or higher. Have a minimum of 21 semester credits in English, economics, mathematics, business, and law courses. You have to have a minimum of 200 hours in approved appraisal courses and perform a minimum of 2,500 hours of appraising in no less than 24 months. Then, and only then, if you want to continue to become like a broker's level in appraising, to become a certified general appraiser, you must minimally have a bachelor's degree from a certified college, have a minimum of 300 hours of approved courses and no less than 3,000 hours of experience over a period of 2.5 years. And at least 1,500 of those hours must be spent on non-residential property. In other words, to become the top dog in the appraisal business, you have to start off as an apprentice appraiser. You barely make a subsistence level of income. Then you become a residential appraiser. Then if you get your associate's degree or better in education, go back to school, do the hours, you can become a certified residential appraiser. And then by going back to college, getting your bachelor's degree, continuing your course requirements and hours of experience, you become a certified general appraiser. So that's the process, and that's the profession of appraising. And that's how they appraise property. So I'm done with the chapter. Please, any follow-up questions? If not, I'm going to pull right up to the review questions in this chapter and move forward. So while I'm pulling those up, if you have questions, now's the time to ask. What page are you reading the appraisal requirements? That's page 288 in your 14th edition hardcover textbook. How long is an appraisal good for? That's up to the appraisal to certify that. It's usually for a limited period of time, but again, it would specifically state in each appraisal how long it's good for. I can't give you a canned answer for that question, Nicholas. I'm sorry. All right, not seeing any other questions. Let's do the reviews, guys. So here you go. What does an appraiser do? And yes, we still do have 2 more chapters to talk about today. Yeah, it's going to be you may have to work straight through the break to get it done, but we will. What does an appraiser do? From the responses, 89% of you are correct, answering C. They estimate value. Correct. Number 2. No 2 parcels of land, what? No 2 parcels of land. And 75% of respondents got it correct. D, are identical. Correct. No, good. Number 3, the appraiser, who works for a number of different clients, is known as a Okay, so we got a neck and neck tie here. Unfortunately, only one can be correct. And it looks like 49% of us who did answer got it correct. And that is a fee appraiser. There's either a fee appraiser or a staff appraiser. There is no freelance appraiser. Number 4, what is value? What is value? Boy, going to be an interesting result here. And from those who have responded, 44% of you are correct, answering D for dog, the power of an object to command other goods in exchange. Now, a good number of people asked B, answered B, the future value of present benefits. It's actually the present value of future benefits. That's why B is incorrect. It's backwards. Number 5, a house should bring 400,000, but it's sold for 350,000 by a hard-pressed seller in a hurry. It is then mortgaged for 300,000 and insured for 375. Its market value then is the real value, which 44% of you got correct, is D, 400,000. Why? Because that's what the market value would be if the guy wasn't under duress. He was in duress, he had to sell it fast. Therefore, he sacrificed the price, but he should get 400,000, and that's what the market value would be. Number 6, an example of an arm's length transaction is one between and from responses, 63% of you are correct, answering D, 2 strangers. 2 strangers. Number 7, an amenity that contributes to a property's value might be its and about 70% of responses got it correct. B, the ocean frontage. Boy, people would pay extra just to live on the front row, right? You betcha. Number 8, market value and cost are often equal when property and 61% of you are correct, answering B for boy, was recently constructed. Yes. Number 9, highest and best use of real estate is defined as the use that produces the most excuse me. And from those responding, about 55% are correct, answering D, the most money. Yeah, the most money. I even said that. Number 10, why should I pay more when I can buy almost the same house new for less? Is an example of the principle of excuse me. And 75% of you did get it correct. It is A, substitution, correct. Number 11, houses are likely to reach their maximum value in when, that's supposed to be when, and from responses, 57% of you are correct, answering D, jobs, houses, and price levels are all similar. Good. Number 12, the cost approach is most useful for Now, from response, about 45% are correct. D, all of the above. Yes, any one of those would be a good project for a cost analysis. 13, from the reproduction or replacement cost of the building, an appraiser deducts depreciation, which represents from reproduction or replacement cost of the building. An appraiser deducts depreciation, which represents 67% of you are correct, answering C. Loss of value due to any cause, not cost, but cause. 14, the difference between reproduction cost and replacement cost involves yeah, this is a big, big chapter. I know it is. I know it's demanding, but it's okay. We'll get through it. The difference between reproduction cost and replacement cost involves oh boy, excuse me. And about 70% of you are correct, answering C, modern versus obsolete methods and materials. Correct. 15, the appraised value of a residence with 5 bedrooms and 1 bathroom would probably be reduced because of 95% of you got it. B for boy, functional obsolescence. Very good. 16, the term economic obsolescence refers to, sometimes referred to as external obsolescence. Excellent. Good, 78% of you are correct answering D, problems beyond the property line, and they're always incurable. Number 17, if a property's annual net income is 37,500 and its value is 300,000, what is its capitalization rate? I gave you ERV. Use ERV. Come on, too many guys sitting on the sideline with this one. All right, whatever. So 81% of you responded, who did respond, got it correct. 12.5%. How did I get that rate? Income divided by value equals rate. 37,500 divided by 300,000 equals 0.125 or 12.5%. B for boy is correct. Guys, remember when I wrote ERV, I did it for a reason. Picture IRV, income divided by value equals rate. There you go. 18, expenses are subtracted from gross rental figures to arrive at debt service. No, that's not the question. Boy, oh boy, that got butchered. Number 18 is expenses are subtracted from gross rental figures to arrive at debt service. That's a crazy question. It's misprinted in the book too. And debt service, I guess, at debt service should not be included. So it should read expenses are subtracted from gross rental figures to arrive at. That's all. And it's not debt services, by the way. Somehow that got misprinted in the book and on the screen, so we'll have to cure that somehow. And the answer is, guys, the net operating income. Gross income less expenses equals net operating income. All right, number 19. Capitalization is the process by which the estimated future annual net income is used as the basis to 89% of you are correct answering B, estimate value. Correct. Number 20. Which of the following factors would not be important in comparing properties under the sales comparison approach to value? And about 58% of you are correct answering D, a difference in the original cost that has no input on what current valuations are. Original cost, no, nothing. 21, reconciliation refers to which of the following? Reconciliation refers to which of the following? And the answer of 71% of you are correct answering C. Analyzing the results obtained by 3 approaches to value to determine the final estimate of value. Correct. 22, in order to become a certified general appraiser, one must have and from those who responded, 78%, I'm sorry, 78% are correct in answering C, a bachelor's degree. Very good. 23, some of the some of the country's foremost appraisers have earned the designation and yes, about 77% of you are correct answering A, MAI, Master of the Appraisers Institute, A. 24, real estate appraisals must be performed by a licensed or certified real estate appraiser, and finish that sentence. Real estate appraisals must be performed by a licensed or certified real estate appraiser. And about 70% of you are correct answering A, regardless of the value of the property involved. Every appraisal must be performed by a licensed or certified appraiser. 25, to be certified as a residential appraiser in New Jersey, an applicant must complete Oh, excuse me. And for 65% of us who answered complete, the answer was correctly. The answer is D, 200 hours in approved real estate and appraisal courses and have 2,500 hours of experience in no less than 2 years. Okay, last two questions are math questions, folks. Get your calculators out. Here we go. An apartment building has $65,000 in potential gross annual income. The vacancy rate is estimated at 5%. Total operating expenses are $29,000. The capitalization rate is 9%. What would be the value of the building using the income approach? Go. I'll work it with you, but I want to give you a chance to do it yourself first. See how well you do. Now, you can always just look in the back of the book and cheat and get the right answer, but you're not going to learn anything that way, guys. So try to do this math. You may surprise yourself. Okay, so obviously a lot of people just throwing their hands up. Very few responses were from those who did respond. 70% of you who answered so far are correct or cheated very nicely. Let's do the math. The math for this calculation is as follows. 65,000, right? That's the gross income. Minus 5% vacancy equals 61,750. Remember, I have to take out any vacancy factor before I can determine what the expense subtraction would then occur. Minus 29,000, which is the expenses, equals $32,750 as the net operating income, NOI. That's the number we need, the annual net operating income to determine value. So 32,750 divided by 9% equals 363, 889. There you go. So B for boy was the correct answer, of which 70% of those who did respond, which was very few, got it correct. So good for you, the guys who did the math and got it right. B for boy. Here's the last question, another math question. I'll do the math again. An appraiser has been asked to appraise a 2-unit apartment building. In this neighborhood, the expected gross rent multiplier is 144. The annual income on the building is $16,800, both units rented. The monthly expenses are $300. What is the estimated market value if it is based on the income approach? Again, giving you a few minutes to calculate, but I'll jump in and solve the equation with you. Just want to see who's trying to work it out and what luck you're having. So not a lot of folks are trying this one either. But from those who are trying, I appreciate the effort, and a good percentage of those who are getting it got it correct. So let's go through it. How do we do this one? All right. So the property has a gross rent multiplier of 144, right? That's the gross rent multiplier. So what's the number we need to use when we're using a gross rent multiplier? Well, I need to determine the gross monthly rent. So 16,800, right? That's the yearly rent divided by 12 monthly equals $1,400 a month. So the gross monthly rent is $1,400. The gross rent multiplier is 144. So 1,400 times 144 equals a value of $201,600. Once again, I know what the gross rent multiplier is 144. Check. I need to determine the gross monthly rent. So the gross income divided by 12, 16,800 divided by 12 equals $1,400 a month in rent. Correct. Gross monthly rent times gross rent multiplier equals value. Check. So the answer was A. Oops. And 51% of those who did respond got it correct. So good for you guys. A. All right, good review, guys. Long chapter, I know. Any questions for follow-up before I bring up and start the next chapter? And give me just a sec while I do that. So I'm looking for chapter 16. Where are you? Oh, that was 16. I'm looking for 17. There it is. All right. So what questions we got? What about the 300 in expenses? Remember, there is no expenses taken out for gross monthly rent multipliers. It's just the gross monthly rent. No expenses are subtracted. When we have math problems, can you give us a little extra time to answer, please? Sure will, Allison. All right. Anybody else with a question before we move on? Question 11, please. The answer was D. Jobs, houses, and price levels are similar, meaning a stable economy. A stable economy, that's what it infers. Anybody else with a question? Question 1, when we did review with Miss Cora, she said answer was A. No, maybe, I'm sure Miss Cora meant C. Because what is an appraisal? It is not a discovery of value, it's an estimate or opinion of value. Why was 5 B? B? 5 was not B, it was D. 5 was D, Bruce, not B for boy, it was D for dog. Anybody else with a question? Isn't. So why isn't 5B? Because 400 is the value. Remember, this is a seller who was hard pressed and is in a hurry, so he cut the price just to sell. Value isn't what the seller's motivation refers, it's what the buyers would pay in a normal market. That's what value is. 11 was D, dog again. All right, I did that a couple times. So Rajni, I'm not understanding what your question is. 11 is D. It is, you say it's not D. Is that a question? I'm sorry, I'm misunderstanding, Rajni, what you're trying to ask. Thanks. It Doesn't help me with your question. Okay, you got it. All right. So anybody else? Brandon Casali, you got a question? I see your keyboard's open. Brandon, no, okay, so you had your keyboard open by mistake. Okay, let's move on then. All right, I'm going to moderate the conversation, guys, and we're jumping into chapter 17, and we're going to move forward. Investment and business brokerage. At the end of this chapter, you should be able to explain the advantages and disadvantages of owning investment property or investing in real estate, and describe the tax benefits of real estate investment and the effects of the New Jersey Uniform Commercial Code. Wow, this sounds important. If you're going to get into the investment business, yes, it is. So what are the advantages of buying investment property, Tim? Well, obviously, number one, the return you get for your investment. What return are you looking for, Mr. Buyer? Well, I'm looking for something that generates me a monthly cash income. Now, there's going to be different terms we apply to different things. A return is what an investor gets back due to his outlay of cash. He may want to know, what's my cash on cash return? In other words, how much per year or month does the property generate in my favor as compared to the down payment I'm making? What is my return when I sell the property? Well, that's another problem you have to work out because of appreciation, differences in market values, what you purchased it for and when you sold it for. So return is what an investor is looking for, return on their investment, positive numbers. Leveraging is using other people's money to accomplish your desires. When you buy a house with a mortgage from a bank, you're leveraging your investment with mortgage money given to you by the bank. So using other people's money is leveraging. OPP, you know me, right? Other people's. And another benefit of buying real estate investment properties is it's an inflationary hedge. What do you mean? Well, think about it. If I buy a property in today's dollars, it's worth $300,000, let's say, and I keep it for 20 years and then sell it tomorrow in 20 years, I'm selling it in tomorrow's dollars. So I'm going to get more dollars because tomorrow's dollars are going to be worth less in the future than they are today. So if I buy something for $300,000, sell it for $600,000 tomorrow, I'm going to make an additional $300,000 in profit. A nice return on my investment, and I'm protected against inflation because I bought it in the past and I'm selling it today, so I'm going to make money, hopefully. So advantages are the return on the investment, the ability to use other people's money, and it's a hedge against inflation. Disadvantages. Investment properties are not highly what they call liquid. Liquidity is a term in investment circles where you take an asset, something of value, that can be converted to cash very quickly. An investment property is not an asset by pure definition, because by definition, an asset must be converted to cash quickly. In fact, it may take a very long time to sell an investment property. I've worked on commercial deals where the investor started the negotiation in X days, and a year and a half later or more, they finally come to terms and conditions. So it doesn't quickly convert to cash. It's not highly liquid. So that's a disadvantage to an investor. Secondly, it requires expert legal and tax information, as well as physical and mental work. You got to do work. You have to do maintenance repairs, take care of physical structures. You have to think, what kind of budget should I create? Should I create reserve accounts? How do I pay bills? What do I do about raising rent? What's about all kinds of things. And like any investment, a disadvantage could be a risk factor that some people are just not willing to take. Now, there is no guarantee in the real estate business that whenever you buy property or invest in property that you're going to make profit. There's general concepts and terms and constructs we agree to, but we can't predict the future. There's no 100% guarantee that you're gonna make money. So in any investment, remember, there are risks. So the investment itself, the property held that you buy, is usually held for appreciation at some time in the future. You get a benefit from selling it for a profit. So if it increases in value, you get a profit. And when you show a profit at some future date, then you've actually created a good investment. It's also property held for appreciation sometimes, and usually does for investment circles, produce an income for the owner. Now, the term I'm introducing is this one first, cash flow. Now, I'm just going to use a whiteboard to try to explain cash flow. Expense or income, sorry, forget that. Income is generated on a property. Less expenses equals net operating income. What's left after the expenses are paid? To determine cash flow, I would then take off debt service, also known as mortgage payment. So if I take my net operating income and minus out my debt service, whatever's left over is called cash flow, F-L-O-W, cash flow. So after all expenses, after all taxes, insurance, maintenance, bookkeeping fees, everything's paid. And when you apply your mortgage payment to the net operating income and there's anything left over, what's left over is called cash flow. Spendable income that the owner generates on a monthly basis from the proceeds of the property. Cash flow hopefully is a positive and not a negative. If you're holding property with a negative cash flow, you're doing something wrong in some manner. So cash flow is a term that is used to describe the money generated after all debts and mortgages are paid. Whatever's left over, cash flow. The term pyramiding through refinancing is a concept I introduced when we talked about the VA loan, remember? Where you can use the VA loan to purchase property with zero down. Since there's tenants are paying your expenses, you keep your money from whatever job you've got. And then a few years later, you refinance the property with the VA loan for 100% of value, take out the cash, to take your savings, and now go buy another property. In 7 years, repeat until you have become the the real estate investment king that you want to become. So pyramiding through refinancing is a way to achieve additional wealth by generating more assets, owned investment properties, from the appreciation you realize through cashing out your finance. Benefits for investment properties. Number one would be the 1031 exchange that is used to defer your capital gains taxes. Many people have never heard of this. Some people have a misconception of what a 1031 exchange is, so I'm going to be talking about that now. So 1031 exchange, what is it? So here I'm going to, hypothetical scenario. I own a $5 million apartment complex here in Hackensack. It's a nice place, respectable, no gum chewing, no spitting, okay, nice place. And I operate it on a monthly basis. I visit the property, collect the rents, take care of maintenance issues, and et cetera, et cetera. And things are going swimmingly. I'm doing well. I bought it for a nice price. I'm getting a nice profit if I sell it. But if I do sell it now, and since I'm thinking retiring, moving down to maybe Naples, Florida or something, if I sell today, I'm going to have a capital gains exposure that I'm going to be bled dry of my profits by just paying capital gains tax. So I got to make a decision. Should I sell or keep the property? And if I sell, then I have this big tax burden. But if I keep it, and I'm going to be in Florida, I have to fly back to Jersey every week or two. It's not worth it to me. I don't know what I should do. So You talk to your friendly neighborhood realtor who says this. Did you know of what's called a 1031 exchange? No, what is it? This is a process whereby you, as a purchaser of an investment property, would go to a qualified 1031 exchanger. So where do you find these guys, Tim? Well, there's an easy solution. For me, I would walk down the road on Bridge Street here until I come to the the Bergen County Bar Association. Stop in if you have a few, no, that's not the bar I'm talking about. You know what I'm talking about, the legal guys. So I go into the Bergen County Bar Association and said, is any members of yours qualified 1031 exchangers? Because usually it's an attorney who's in a 1031 exchanger. And they say, we have several, take your pick. So I go and talk to one of the 1031 exchangers. I tell them my dilemma. I got this $5 million apartment building in Hackensack. I'm moving to Florida and I don't want to come back here, but if I sell it, I'm going to have capital gains tax. How do I get out of this scenario? Mr. Jensen, says the 1031 exchanger, maybe we have an idea for you. Here's how a 1031 system works. Number one, if you were thinking about getting rid of your property, what you could do is submit your property to my 1031 exchange network. Your property being submitted is called the relinquished property. You're giving it up. Now, through our network, we could find buyers and sellers of all kinds of properties. So what we're looking for, a $5 million investment, we're looking for a replacement property, the one you're going to take, of equivalent value of $5 million. And it should be in Florida, right? Yes. So let's enter the exchange and find out what's available. Well, some guy in Oshkosh wants to buy your $5 million property so we can get rid of it very quickly with no problem. And through various and sundry connections, we find out down about 50 miles away from Naples, there's a $5 million warehouse for sale. Would you like to manage a warehouse? You know what? If it's the same value, I don't mind because, it's just a matter of different ways to work, but yeah, I'll take it. So what happens is I enter my property, the relinquished property, into the exchange. Technically, it is sold to the exchange. However, they use the words it's exchanged. Because it was sold, then I'd have to pay taxes on it. But in an exchange, I don't. If I identify and take possession of a replacement property within 180 days of posting my relinquished property. So he discovers the property in Florida through his network connections. Some guy in Oshkosh buys my property for $5 million. I take my $5 million, buy the $5 million warehouse in Florida. We have completed a 1031 exchange, dollar for dollar, like-kind property exchange. I relinquished my $5 million apartment building and took a replacement property of a $5 million warehouse. Investment for investment, dollar for dollar, zero capital gain exposure to me at the exchange. Instead of selling the property and suffering hundreds of thousands of dollars in capital gains penalties, I'm able to defer my tax penalties until I sell the property in Florida years from now. Now, anytime I can defer taxes is a tax favored status to me. So a 1031 works for investment properties only, not your residential properties. You can't use it as an exchange. If I have a $5 million property here, I can exchange it for a $5 million property here, or $2.5 million properties of investment quality. So as the dollar for dollar is exchanged, no capital gains exposure today. However, the property in Florida is only worth $4.5 million. So what happens when I have an unequal exchange? Well, the thing is, if I'm giving up $5 million and buying $4.5 million, that means I'm getting a $500,000 cash difference payable to me from the proceeds, which means there's a difference in the exchange price. The difference in the exchange price is called a boot, and the boot is taxable at the point of exchange. So I would owe capital gains on $500,000 only, not my total tax exposure. So the boot is taxable at the point of exchange, but if there's no cash difference, then there's no tax exposure. Now, that was a very quickly and succinctly idea and presentation of a 1031 exchange. Did anybody not understand what I was talking about, or get lost, or tell me to get lost? Who pays the boot? The person benefiting from the exchange. Me, I benefited by 500,000. I pay the tax on the boot. If the other person got it, let's say I'm buying a $5.5 million property, he gets the benefit of the increased value exchange, then he pays the boot. How long are the taxes deferred? Until I sell the next property down the road, and that could be forever. I could pass it down to my son. I might have missed this, but does the 1031 exchange work for residential property? And yes, you did miss it, Tiffany. And I said, no, it does not work for residential property. It's for investment property only. Can I argue that the boot was part of the principal cost and not the profit? Michael, you can argue anything you want with the IRS. Let me know how that works out, okay? If you list your property but can't find one to exchange, what can you pull out of the new? Yeah, what you can do is, if you don't find a replacement property and take possession in 180 days, you can withdraw your property that you're redeeming, so that you do it again a different day. You can withdraw from the exchange. Yes. If you lose money, you can get a tax write-off. Yep. It's always nice to have a loss once in a while. What if property you buy in exchange is more than 5? Again, Anastasia, if it's more, then the person who benefits from the difference, the boot, has to pay tax on the boot at the exchange. So the other party would have to pay the tax. What if property you buy in exchange is more than 5 million? Again, that was okay. We answered that. What's the rate going to be on the boot? Whatever you qualify for Farhana, you may qualify for different rates than I do. Can you exchange for 2 properties for? Yes, you can. I did say that. Guys, I'm sorry, but you got to listen, guys. I did say all these things you guys are asking me questions on at least once or twice. All right. And I'm not seeing any other questions, so I'm going to assume everybody's cool with this. Investment properties include rental properties. Yes, that's what we're talking about, investment properties. All right. The capital gain is the difference between the adjusted basis of property and its net selling price. The what? Well, first of all, let's understand what a basis is. A basis is the investor's initial cost to buy the real estate. The adjusted basis is the basis, what he paid for it, plus the cost of all capital improvements he's made on the property minus claimed depreciation. So let's say I buy a property for $1 million and I hold the property for 20 years, but over the course of 20 years, I put in new AC systems, new roof, redid each apartment, et cetera, to the tune of $400,000. My adjusted basis, first of all, would be the original basis, $1 million, plus the cost of capital improvements, $400,000. So now I'm at 1.4 value as adjusted basis, minus claimed depreciation. And I'll talk about depreciation in a minute. Depreciation is a tax accounting concept of taking off value for depreciation on the improved value over the economic life of a property. And again, I'm going to talk about that in a minute. So that's what capital gain is based on, what the basis, the adjusted basis, minus depreciation versus the purchase price. All right. Now, depreciation, the context of which I just tried to explain very briefly. And the answer is, it is a loss of value in property due to any cause, including physical deterioration. However, for accounting purposes only, depreciation is a loss of value on the improved value of the real estate, over its economic life. Now, let's define terms. Improvement value. So on your tax bill, you have an assessed value of your real estate. It's broken down into land value and improvement value. To do depreciation for tax purposes, I'd have to back out the land value. So let's give an example. I buy an office building for $375,000. The assessed values are the improvements, $300,000, and the land is $75,000. So I would subtract the $75,000 out of the equation, and now the improved value is $300,000 according to our market rate. Okay. So now this $300,000, the improvement on the property, for tax purposes only, has an economic life. For a residential investment property, the economic life is 27.5 years. For a commercial investment property, the economic life is 39 years. So what I would do, I was to take my improved value divided by, for a residential property, 27.5 years. So if I were to do that, take 300,000 divided by 27.5 years, I'd have $10,909.09 per year loss of value, so I can write that off against any income I generate. It's a tax deduction that I get of $10,909.09 every year for 27.5 years that I can use to write off against the income I produce as an income stated on my tax returns to pay less taxes. So there's a benefit of owning investment property through depreciation. But that's for property that's got an economic life of 27.5 years. What if it's 39 years? So then I'd take 300,000 divide by 39 years for an annual tax write-off of $7,692.31. So I can use my investment property and depreciate it for tax accounting purposes only over its economic life of a residential investment property, 27.5 years, for a commercial investment property, 39 years. And then subtract that deduction from my income and pay less taxes. That's the benefit of depreciation. Once again, it's a loss of value on the improved value of the property, but it's not an actual loss of value. It's a loss of value for tax purposes. The market value may still hold this value or even be up. But according to tax write-off legislation, the depreciation is allowable to an investor per year. So I write off the authorized, or whatever the determining economic life is, 27 or 39 years, divide that into the improved value, gets my tax write-off for depreciation every year. Questions about depreciation? Does the years get reset if the property is sold to a new owner? Yes, it does, Yang. Exactly. So once I reach the end of my economic life, I have no more depreciation write-offs. I sell the property, and whoever buys it, he creates a new economic life when he buys it. Does the depreciation clock reset with each new owner? Yes. Refinance, reset with a refinance. I'm sorry, Nicholas. I'm guessing your question is, does depreciation reset with refinance? Is that your question? I'm trying to guess here. I don't know because I don't understand your question. Oh boy. Refinance, boy, I'm sorry. I don't understand what you're trying to ask me, Nicholas. I'm sorry. You're gonna have to do better than that. think Nicholas means, does the depreciation clock reset if the same owner refinances? Boy, I didn't get that, but you did. That's awesome. So Nicholas does say, does the depreciation reset with a refinance? The answer is no. I'm sorry, I did not understand that, but now I do. Thank you for explaining it. If you don't claim depreciation at the end of the year, can you, I guess, can you accumulate depreciation at the time of the sale? That, my friend, is something you have to talk to a tax advisor. I do know that there are alternative tax accounting methods for different purposes. I'm not a tax advisor. I'm the last guy you want to ask about how to fix your taxes. I can't help you there. I'm sorry. Was there any other questions before we move on? If you don't, okay. I guess there is no other questions, so let me try to finish up one or two more concepts before we break. Well, cost of improvement includes residential property and improvement minus the, well, wait a minute. Cost of improvement includes the residential property and improvements minus the, boy. I'm sorry, Michael, again, I'm trying to. Let me try to guess. Do the cost of improvements include the residential property and improvements minus the land value? Is that what you're trying to ask me? I'm hoping it is, because that's the reason, that's the kind of understanding I get from it. Okay, I don't know. Again, I don't know what you're asking. Okay, I got to move on, guys. I'm sorry. All right. Deductions and federal tax law. Federal tax law limits the deductibility of losses from residential property or rental property. Actually, there's something called the passive loss rule, in whereby if you're operating several profit centers and you have one that's at a loss, you can use the loss of one to offset the profits of another to minimize your tax exposure. It's called the passive loss rule, and it is a viable tax weapon you can use. How it works is that the first $25,000 of loss can be used to offset income from another investment source. So let's say you made $50,000 here, but lost $20,000 over here. You can take the $20,000 loss and apply it towards the $50,000 you benefited by profit. So you reduce the actual taxable profit by $20,000 and pay less taxes. That's using your deduction for a corporate tax loss. The investor must have actively participated in the management and operation of the property and has taxable income of less than $100,000 before the deduction is made. So if you have other deductions that are of greater value, or certainly you would want to make the capital, passive loss deduction before your taxes are reduced from other write-offs. So you have to do it in a specific way to record that benefit. And it's 2:30. Let's take a break, guys. We're going at a quick pace, but do me a favor, 15-minute break, because we still have another chapter to get through after this one. So 15 minutes only for a break, and we'll come back and hit it hard. So I'll see you in 15. Okay, it's 2:45. I told you 15-minute break, and I was serious. We got to get busy, guys. We got a lot of ground to cover and not a lot of time left, so let's get cracking. Tax credits. We talked about tax deductions. So what's better, a tax deduction or a tax credit? Well, let's see how they work. So I'm going to use a whiteboard. So let's say I make $100,000 a year in income, okay? So, and I'm in a 30% tax bracket. That means I owe $30,000 in taxes based on my $100,000 a year income. This is a very simple explanation. $100,000 in income, 30% tax bracket, I owe $30,000 in income tax to the federal government. If I have a $10,000 tax deduction, how that's applied is against my income. So I'd reduce my $10,000 income, my $100,000 by 10K. So really I'm only getting $90,000 a year for income because of my $10,000 tax deduction. Times 30%, I only pay $27,000 a year in taxes because I save 30% of the $10,000 or $3,000. Therefore, I reduce my tax bill by $3,000. Simple. But what if it was a $10,000 tax credit? Well, a tax credit is a dollar for dollar against taxes owed. So I do not adjust my income, but instead take $10,000 away from the taxes owed. So in effect, I only owe $20,000 in taxes. And I save $10,000 a year in taxes I got to pay. A deduction results me in the percentage of the taxes due. The tax credit saves me the full amount of the credit by removing that from the taxes due. Dollar for dollar against taxes due. So in most circles, people would rather take the tax credit as opposed to a deduction. But if you offer me both, I'll take both. I'll take them out. So tax deductions, reducing your income, thereby reducing your tax exposure. Tax credit is a dollar for dollar against taxes owed, therefore reducing your taxes owed. All right, moving on. Installment sales, as I said earlier yesterday, is a special form of seller financing. Now, installment sales, sometimes also described as a deed for trust, is a way where I can sell my business to a buyer who will give me a down payment and installment payments until he's paid off. Most small businesses are sold through installment sale process. If I was to do this with a buyer, he would give me a down payment and make installment payments for however long we agreed to that period should last until he pays off the money. And only then will the deed, which has been held in trust for the entire time, gets released. So he now is the bona fide owner of the business or property. However, if he misses an installment sale, I can boot him out of the property because I control the deed. It's my property. I can just go to have the sheriff evict him and I'd be out of to have him gone in less than 3 months, hopefully. But this is an issue where, especially when buyers are using seller financing through installment sales, they have to make their installment payments or else they're in default and they're going to lose the property and all the money they paid and never get the deed. All right, real quick, was there any questions that I missed? Let's see. Nope, there was no questions, so good. Oh, is there? So installment sales example is bank loan. No, it's not a bank loan. It's seller financing. Let me try to illustrate it in a different way on a whiteboard. I'm selling my business for $100,000 or the building, whatever. So what I do is I make arrangements with the buyer because he wants to buy it to give me a down payment, an initial payment of $40,000. The remaining $60,000 are made up to me through installments. So let's say there's 60 installments, $10,000 per installment. Now, when he buys the property, I don't get the 100,000, I get 40,000. Plus, I get a promise to make 60 $1,000 installments payments to me. So that's roughly, if it's per month, then every month for 5 years. So after 5 years, after completing all the installment payments to me, the deed, which I have been keeping in a trust, it's not released, then gets released to the buyer, and he is the bona fide owner of property. However, let's say he's 30 months into this. He's paid me $30,000 and he stops paying. Well, then I'm not going to give him the deed because he's in default of payment at 30. He still owes me 30 payments. Therefore, I call the sheriff and have him evicted as a tenant who hasn't paid his rent, because he's not the bona fide owner and I control the deed and trust. I already proved that I'm the owner. All I have to do is have him evicted. He loses his entire investment of 60 grand. I keep that, and I keep the deed, and he's out on his keister. But if he completes the installment payment to me, then I give him the deed from the trust, and now he's the bona fide owner of property. Questions? Installment sales is basically like rent to own with down payment, pretty much, with higher risk. Exactly. Yes. Priscilla, you nailed it. It's like a rent to own, but with high stakes gambling is where it's at. Yeah. All right, let's move on. I'm going to moderate. Oh, is there a difference? Is there interest on the installments? Yes, there would be an interest on that. Or I could just use straight installments, including my interest on it. All right, real estate investment syndicates. A syndicate is a coming together of two or more people or entities of like-kind interest to carry out one or more business objectives. So a syndicate could be, let's say, I'm a realtor, Tim the Patrick, the TNT organization, right? TNT, I like that. We buy houses. In other words, we come together, form a syndicate to buy houses, fix up and resell. We flip them and make profit. TNT Homes. Boy, I like this idea, Tim. But the thing is, it's usually for a temporary arrangement. So let's say the TNT factory says we're going to do 10 houses. We go out and do 10 houses. Once we read our profits and we do accomplish the 10 houses, we terminate the syndication and go back to doing what we did as we started. Different interests, etc. So a syndicate is a temporary coming together of two or more like-kind parties to carry out something bigger than either one alone can do. Together, the TNT organization bought and flipped and made profit on 10 houses, then we dissolved the syndication. A joint venture, on the other hand, is a temporary situation or organization created by two or more entities of dissimilar kinds to create something bigger than either one alone could do. If you go down to Manhattan, no, don't do it today because it's going to snow, but if you did, you'd see that there's like construction cranes on almost every corner. So you go up to one of those construction sites and there's a big placard on the side of the building. It says, Tishman Contracting and a joint venture with Citicorp are building this 77-story luxury apartment tower. Two dissimilar entities, a bank and a contractor, coming together because either one's a builder, one's a banker. They can't achieve both purposes, but by coming together, they can finance and construct this building. And then when it's sold and they realize their profits, they dissolve the joint venture and go back to their separate ways. Real estate syndicates, business ventures in which a group of people pool their resources to buy and develop particular pieces of property, and then to resell and make profits by. So understand, guys, syndications and ventures are usually temporary forms of organization that dissolve once the objective is completed. General partnerships, on the other hand, is usually a number of partners in an organization all having the same managerial responsibilities, all sharing equally in profits and losses in a general partnership. In a limited partnership, there's usually one general partner and everybody else is a limited partner. The limited partners are only liable to the extent of their investment, where the general partner takes the lion's share of responsibility for liability. But on the converse, the general partner usually realizes the lion's share of profits, and each investor is given their profit as to the percentage of their limited investment. So limited partnerships are sometimes used for various reasons and things like that, but there's usually only one general partner in a limited partnership. Real estate investment trusts are organizations that come together, sell bonds or something on the open market to raise funds, and those funds they raise are used to buy properties that produce income. Now, real estate investors can take advantage of the same tax benefits as mutual fund investors. A real estate investment trust must have at least 100 investors, and at least 75% of the trust income must come from the real estate operations, the income derived by the properties. They use that income to pay off investors and operational expenses, and through tax benefits of depreciation and other write-offs of capital expenditures and such, take tax benefits to minimize their corporate tax on the properties. And then when the economic lives are ended, they get a vote of the shareholders to sell the properties, and they release them from the trust and sell the properties, hopefully for profit. Business opportunity sales. From time to time in your real estate career, you may have the opportunity to sell a business. My first opportunity came in 1997, I believe. Yeah, 7. I remember this because I was in broker's school when I got a call. It was a guy I had sold a house to in a nice subdivision called Rio Vista in Mahwah. At that time, the houses were about $500,000. Now they're about $1.5 million. And he said, you know what? I like the way you handled my transaction. I'd like to have you sell my sports bar, if that's possible. I said, sure, absolutely, Bob. And then when I hung up the phone, I said, what the hell am I doing? I never sold a business before. I could wreck this guy financially. So at the end of class that day, I hustled back to the office, got on the phone, and found one of my associates who working in the company. He's been around the block. He was much older than I at the time. And I said, John, I have a question for you. What's that? He goes, would you like to help me sell a sports bar? He goes, absolutely, Tim. You know, that's my specialty. I said, yeah, but here's the thing. I'm the listing agent, and I'd like to give you some income, but you have to train me. What do you mean? I said, I've never sold a sports bar. He goes, okay, I tell you what, 35% of your cut in the profits, and I'll help you figure it out. So I arranged it with my broker that when we sold the property, John would get 35% of my paycheck. I figure 65% of something's better than 0% of nothing. Because if I didn't get John to help me, I wouldn't have known what to do, and I had to decline the business. So as it was, John and I went to meet the guy. We discussed things about his valuation, the business and everything, put the business on the market, and 1 year later we sold it. But to do this, I had no clue on how to sell businesses. I didn't know what questions to ask, how to value a business alone. So John and I went to meet the owner on our first impression, and we sat down. And John started asking questions about valuation. His first question he asked is, how much value do you put on your goodwill? Now, me as a greenhorn, I'm sitting there going, what the hell is he talking about, goodwill? Doesn't everybody have goodwill, right? Peace on earth, goodwill to men. What is that all about? No. Goodwill is how your community views your business as far as being a neighbor and the importance of being a neighbor. Think about it. If I'm a business in town and I can contribute in some way to give a positive input into the community development, they would view me as a good neighbor and want to frequent my establishment. So in the town of Oakland, where I live, normally if no COVID existed, we would have had the Halloween parade at Halloween, where all the kids dress up and the mayor gets to say, hey, you're the top prize winner, and get photographs of all the kids, then get our face in the pictures, you know, in the papers. Well, here's the thing. During that Halloween parade, those kids work up a little bit of a powerful appetite and thirst. So Dunkin' Donuts contributes dozens and dozens of munchkins. ShopRite contributes bottled water, bottled juice packs. You know those little juice packs that kids eat all the time, drink all the time? Starbucks may supply some canisters of tea or coffee or mocha latte frappuccino, extra extravagant grande lattes, and all kinds of $12 drinks, but they give them to them for free. These are community-involved businesses that give back to the community. Maybe a business sponsors a Little League team or pays for ads in a yearbook for the seniors. That's goodwill. Giving back to the community. The community recognizes and then patronizes that business because they like how community-minded they are. That builds value in a business. Well, so does the fixtures in the stock and inventory, the business name. Customer lists are valuable. Special rights like copyrights, secret recipes, franchise licenses, and a sports bar, liquor licenses add value and could be a lot of value. So we have to discuss all these things with the business owner to try to come up with some sort of value proposition of the business. Other things could include things like accounts payable and accounts receivable as a value added or subtractive item. If you have a large outstanding accounts payable, that means your business owes vendors, and I would pay less for your business because I would have to pay off those vendors. Or if you have a large accounts receivable, that means there's money due the company that hasn't been collected. I'd like to see that list to find out how much of those dollars I could probably collect. That could add value to the business. But again, at some point, some of those debts are not collectible. I have to make a value-based judgment on those things. So typically after coming up with a valuation, including figuring out what kind of leases or ownership the property has, and if the property comes with, if the business comes with a piece of property through a lease or ownership, then obviously a real estate license is required. But if it doesn't come with an interest in real estate, then you don't have to have a real estate license to sell the business. Who doesn't have a interest in real estate? I don't know, Avon. I mean, some of these people go out, sell products door to door or on the phone or internet. They don't have an office. They don't have a warehouse. They're just doing it out of their house. So other businesses like pizza joints either lease or own the property, therefore probably requires a real estate license to sell. Now, normally financing a business is most commonly done through the installment process, giving a fairly nice down payment and then installment payments over time. And then when the installment payments are done, the seller releases the deed of ownership to the business to the buyer, and they are the bona fide owner of the business. However, like in installment sales, if they default on their installment payments, then the seller of the business can come back, reclaim the business, kick them out, and keep the profits he received from all the installment payments and down payments. It's his money. Small businesses, you may have noticed that usually you see signs like under new management, and then maybe 6 months later, original owner back. And you're like, what the hell's going on? Well, that new owner couldn't compete because he doesn't know what he's doing. He's got bad management or he underfunded himself, and he's out of business. Therefore, the original owner kept all the installment payments and a down payment, came back, reopens the business, tries to establish a value again, and maybe then sells it again. It happens quite often. So substantial down payments, purchase money mortgages for balance of selling prices could be offered, but again, installment sales are usually the way it's done. And in the sale of any business, if any personal items are transferred, trade fixtures are actually called personal property items of the business owner and add value to the business. So if the trade fixtures are sold with the business, then the Uniform Construction Code under the Bulk Transfer Act requires that all private property unrelated to the real estate, trade fixtures are private property, be noted and values assigned to them. So it helps prevent fraud when the business is sold and regulates the transfer of the real estate business so that the IRS and your state know exactly how much the real estate was and how much the personal property items were, et cetera, et cetera. In New Jersey, the Uniform Construction Code under the Bulk Transfer Act is designated or designed to protect buyers and sellers' creditors. So when purchasing a business, they must post a list of creditors, usually in the county records department, a good 6 months before the sale. So those who need to even up with the business are given notice. It's usually a good idea to leave up that notice for additional 6 months because creditors have an additional 6 months after the business is sold to come even with the owner. And real estate brokers cannot draw up these contracts. These contracts must be drawn up by an attorney, especially since it's a business and it's not a residential building. So they have to write up the contract and all other paperwork associated to it. Non-compliance with the Bulk Transfer Act is a criminal offense. So it is required that all these things be noted in the Bulk Transfer Act. Ergo, now we're done with this chapter. I know I went through it rather quickly, but you pre-read this, so you probably have a better comprehension than I did. So if there are no questions, let me go ahead and pull up the reviews for chapter 17. Excuse me. Is there interest on the installments? Yes, there is. I think I answered that before. Was there any other questions? Michael Blum, did you have a question or did you just forget your keyboard was open? Quick cue, both syndicate and ventures are temporary. Confirmed. Confirmed, Michael. Moving on, let's do the review questions. Number one. Among the advantages of real estate investment is, we talked about a few. What was one of them? And from the limited amount of responses I've got, 2 out of 3 of you are correct answering C. It's a hedge against inflation. C. Number 2, among the disadvantages of real estate investment is, and about 67% of those who responded have it corrected as B for boy, the need for physical and mental effort. Yes. Number 3, the investor's initial cost for the real estate is called and about 84% of you are correct. B for boy, basis. The basis is the initial cost to acquire real estate. Number 4 of these, the beginning investor would be wise to start with the purchase of And about 80% of you are correct answering D, a nearby multiple dwelling. Yes. Remember pyramiding through and refinancing? I was using the multiple families as an example. Number 5, a small multifamily property generates $50,000 in rental income with expenses of $45,000 a year annually, including in that the $35,000 debt service. The property appreciates at $25,000 a year. The owner realizes another $5,000 through income tax savings. On this property, the cash flow is. On this property, the cash flow is. Not a whole bunch of responses, but from those who did respond, about 58% are correct. A, $5,000. Why? Well, here's the reason. Using the whiteboard, cash flow equals income less expenses less debt service. So income was 50,000. Total expenses were 45,000 because it was expenses plus debt service together. Therefore, the cash flow equaled $5,000. Remember, cash flow is what's left over after all expenses and debt service is paid. So the mortgage payment of $35,000 was included in the $45,000 of expenses. So A was the correct answer. But number 6, same question, except the question is the owner's return is how much? Same question, just a different qualifier on the question now. The owner's return is what? Okay, very limited response again, but from those who did respond, 50% of you are correct answering D, 35,000. How do you figure? 5,000 for cash flow, 25,000 a year in appreciation, and another 5,000 in income tax savings. That's $35,000 return for the investment. Number 7, leverage involves the extensive use of and from responses, 85% of you are correct answering B, borrowed money, using other people's money. Number 8, a property's equity represents its current value less which of the following? Now, guys, I've been writing this equation now for 2 days. What is equity? Value less what? So 1/3 of you answered A, depreciation. No, that's not correct. Another 15% of you answered D, selling cost and depreciation. No, that's not correct. The remainder of you got B for boy, mortgage indebtedness, which is correct. Equity equals value less debt. I wrote it on the whiteboard how many times over the last 2 days? Just a reminder. Got to remember this stuff. An investor's marginal tax rate is I didn't go over it because it is in the book and you read it. So those of you who read it will know the answer. An investor's marginal tax rate is and for saving some time, 45% of respondents answered correctly C, the applicable income, top applicable income tax bracket. Number 10, the primary source of tax shelter in real estate investments comes from the accounting concept known as ooh, that's it. Ooh. Like that with my back scratcher. It really works out well when I'm sitting here all by myself. The primary source of tax shelter is real estate investment comes from the accounting concept known as depreciation, and 55% of those responding got it correct. Number 11, for tax purposes, the initial cost of an investment property plus the cost of any subsequent improvements to the property less depreciation represents the investment's excuse me. And the answer is 62% of respondents answered correctly A, adjusted basis. Number 12, the money left in an investor's pocket after expenses, including debt service, have been paid, is known as, and I just talked about this. Awesome. 85% of you answering got it correct. Cash flow, C, cash flow. 13, the investor who secures what the IRS regards as excessive tax shelters may be subject to, again, I didn't go over that aspect, but it is typed in your book. So if you read it, you should know. It looks like some people did read the text. Outstanding. Outstanding. And about 53% of responses got me C, alternative minimum tax, correct. 14, the property owner is exchanging her apartment building for an apartment building of greater market value and must include a $10,000 boot to even out the exchange. Which of the following may she use as a boot? And I'll give you a hint. It's D. 75% of you anyway had the correct answer, but each one of those answers has the same monetary equivalency. Therefore, they are all appropriate. Number 15, two parties exchanged properties that included $10,000 boot payment. In this situation, good. Looks like you guys have gotten it. So from the responses, a good 70% are correct, answering C. The investor receiving the boot may owe tax on the $10,000. Number 16, an investment syndicate in which all members share equally in the managerial decisions, profits, and losses involved in the venture is an example of which of the following? And the answer is D, general partnership, of which 75% of those responding got correct. Number 17, the buyer purchased a dilapidated 50-year-old house that is 50 years old and has no particular historic value. Helen intends to renovate the row house and live in it. On her renovation expenditure, the buyer is entitled to a tax credit of... Boy, I really do need to push you guys because I'm just going to give the answers here. We have to get the next chapter into. The answer is B for boy, 0. Number 18, in the sale of a business that involves an interest in real estate handling a transaction requires a D for dog real estate license. 19, the Bulk Transfer Act requires the purchaser of a business to, let me see what the choices are. B for boy, notify creditors before the sale. Yes, correct. And lastly, number 20. After learning of a sale of a business, suppliers who have not been paid should take action within C, 6 months. Again, all the answers to the these review questions for each chapter are in the back of the book as well. So I do need to press on. We have an hour left to get another chapter in, and I think we can do it. If you just bear with me, guys, I'm going to power. And I mean go straight through this chapter. So please give me your attention. If I can find the chapter in the texts, there it is. We're going to move onward. Subdivision and development. There's different ways to amass wealth in real estate. At the end of this chapter, you should be able to describe the various methods of developing and subdividing land and identify the impact of environmental regulations and other laws on sales, health, and safety of building regulations. So the two methods described here of building additional wealth through real estate are, number 1, assemblage. This is where you combine 2 or more lots into a larger parcel to increase its value. Just because you put lots together doesn't mean it necessarily increases value. However, let's think about situations where it could happen. So specifically, I'm referring to Jersey City circa 1985. The city council passed a referendum to increase the number of resale units in the town dramatically. So people went out and started buying vacant lots, rundown houses, or properties next to vacant lots to assemble them into larger lots. Then they went before the town zoning board and said, we'd like a zoning change to, instead of single family units in this big area, we'd like condominium licenses. And they granted them the zoning change or the variance. So they now built 100-unit condo units, and they made millions and millions of dollars on the resale. They acquired small individual lots, assembled them into a bigger one, and then built a monstrosity of a building to create additional wealth. That's a way to create wealth using assemblage. The other way is through subdivision. Subdivision is where someone identifies a underdeveloped acreage parcel of property. It says, you know, if I could buy that, I could rezone it for a different use and then subdivide it, sell the lots off, and make big profits by selling each unit off. So what they do is they buy that division, have it rezoned or planned for a certain development. Then that developer subdivides all the lots into individual parcels, let's say housing lots, and then sells those to the builders and to end users. And by selling individual lots, he increases his profit geometrically as those lots are sold, especially in areas where acreage is hard to come by. Now you know why farmers are getting offers of millions and millions and millions of dollars to sell their farms to developers so they can turn around and turn them to residential homes and sell them for tens of millions of dollars. Yep, it's happening. So a developer, by definition, builds homes or other building lots or other buildings on lots and then sells them. A subdivider is someone who buys property and then subdivides it by creating at least one additional secondary lot from one single lot. That's a subdivider. In New Jersey, as soon as a second lot is sold off of a larger parcel, the development is classified as a subdivision. A minor subdivision usually has 1 to 2, maybe 3 or 4 properties being developed with no streets. A major subdivision is anything with streets and multiples of homes on them. Major subdivisions require public hearings, and the board that hears public hearings for subdivisions is the planning board. Now, your planning board is a group of volunteers and professionals that chart out things for how do we plan for the future? Where do we want to take our town and how are we going to develop it or redevelop it? What about applicants to build subdivisions and subdivisions? Do we want those to occur, or do we have other plans for that land? So when a developer comes in, a subdivider, he will contract in a piece of property subject to getting approvals from the planning board. He'll bring his project before the planning board. If the project he brings before the planning board is in harmony with the master plan in the town, and I'll talk about that in a second, then the planning board is more likely to approve the development. So what's a master plan? In 1976, New Jersey created the municipal land use laws, governing how municipalities can use and develop and redevelop property. One of the things that the land use laws created was the requirement for every municipality to operate and update as required a master plan. A master plan is a compendium of documents and articles and papers that show the history of the town, how it was formed, incorporated, or founded, why it developed a certain way it did, and throughout history, what were the pressures exerted on our town? Why did it develop in a certain way? What were the things that were occurring in society that caused us to develop in this manner? It's also a current statement of where your town is, including things like lists of current man-made and natural resources that are inventoried so that we can have an idea of what brings value and why do people get attracted to this area. It's also a statement of what's going on around you and what pressures are being exerted against your town today to develop in certain ways. And it's also a forward-looking document to say in about 5 years, in about 20 years, in about 50 years, this is where we'd like to be. We have plans of redeveloping or developing certain undeveloped areas. We want to redevelop certain areas. We want to bring in this. We want to incorporate that. Well, these are all wishful thinkings, but if a town wants to progress in that way, then the planning board will record that in the master plan to say this is our future plans. Now, according to the state of New Jersey, that master plan must be reviewed once every 6 years by the planning board, then updated as required. So now we got all that out of the way. Land planning requires actual subdivision and compliance with the master plan. So if I'm a working professional realtor in an area and I know what the master plan is in a town, and I have sub-developers or developers or builders that want to know projects where they should do them, if I know what the intentions are of the town through its outlook, through its master plan, I could bring that developer before the planning board with custom development plans that suit the master plan requirements. Most likely, they're going to get approved for development. But if I don't know what the master plan says, then I could be useless to an investor, to a developer or builder. Ergo, as a professional realtor, I should know what each town's master plan is looking for as far as development if I'm working with developers, builders, and such. If you're not, then who cares? But again, as a professional, if you're going to be dealing with this type of in the industry, you need to know what's in the master plan so you can advise your clients accordingly. Now, through land planning, which is administered through your planning board, they want to know, Mr. Developer, how are you going to build this project? How are you going to subdivide the lots? Where's it going to be located? How big will the lots be? Can you give us a plat plan, a map of the area, so we can reference where the streets are, where the lots are delineated, where the houses or buildings are in the lots, where are the drainage easements, where are the public right-of-way easements, where's the sidewalks, the streets, etc., etc. They want to know all of these things. And by the way, when you're done building, are you going to dedicate the streets and sidewalks back to the town? Or is this going to be a gated private community? And if so, remember, since you're not allowing public access, then the fire department can't answer calls, the police department can't answer calls, first aid and EMS can't respond to calls. You have to get your own private services to do that. Or will it be dedicated to the town, a gift of private property to the public entity, is called a dedication, then we can go in there and service the needs of the residents. So we have to work those things out. Developers have to bond their projects with the municipality to ensure that their municipal requirements for street and sewers is fulfilled. And if they don't do it all, then the bond is used to complete that. And the developer must be aware of the zoning ordinances governing the lot sizes, fire and safety ordinances, and all other issues regarding what they can and cannot build, so that when they do present their project, they're going to get a positive response. So subdividing seeks out raw land to profitably subdivide it and determine its use, which is consistent with the zoning requirements of the town, locating financial backers, initiating market strategies, building your subdivision, selling to developers and builders who can then, you can reap profits by selling those lots off. And each time an individual parcel is sold, then deeds would convey those rights to the owners. So they would make up deeds of conveyance for each parcel. Subdivision also considers the street patterns. How's it going to be laid out? Some towns, the fire department has direct input here because if they have cul-de-sacs or sharp corners, they have to judge if a fire truck, and the size of fire trucks has grown tremendously, can navigate the streets of the development. If not, they may not approve the development just for that alone. And how the building's going to be laid out. Today's thoughts are that we could use more open space in developments. Therefore, we'd like to see clustering of property buildings into certain groups, which affords more open space throughout the complex for parks and recreation, that kind of stuff. Will there be a homeowners association, Mr. Developer? And if so, what are the covenants, conditions, and restrictions, the CC and Rs, so the town knows that people are abiding by the rules and regulations? Are you going to have FHA standards imposed on the building so that when people want to buy with FHA loans, they could, or will it not be in compliance with those so it's not an FHA qualified community? And there's a lot of those. What are your developments cost? How much is it going to cost you to develop this thing? And what about density of population? That's a big concern because of quality of life. You're going to put 200 people in one building. That's kind of serious densely populated structure. What if you had separate buildings with lesser people? Wouldn't that be more economically and socially desirable? Or is one building the way you want to go with a monolithic structure, 200 units in a building? These are all things that a developer has to consider and the planning board must consider. The development, the density, and everything with it. Now, under environmental issues, what if there was problems with past use of the property? In other words, someone had littered and there's toxic waste on the property. Well, if you can't find those old owners or they're long gone and you just found out the problem, you may not have recourse to the sellers of the property or the current owners. So what you're going to do is say, Mr. Buyer, you may be responsible for the cost of these cleanups. And if so, then the buyer is responsible for the cost of cleanups. He has to call the EPA. They'll do a phase 1, which will inspect the property and determine if there's any toxins. Phase 2, the extent of the infestation and what it's going to take to remediate. Phase 3, the immediate and necessary cleanup of those toxins. This costs a lot of money. Who's going to pay it? Developer. However, for you guys who work with developers, remind yourself of this. If they're using a property that has been polluted and by result of cleanup return to the taxable rolls of the town by building a structure that can be taxed, then there's brownfield funding available to those developers. Brownfield funding. This is money given to the developer by municipalities and counties to redevelop property and get rid of toxic waste, so long as the property becomes a taxable property. When the developer's done, they'll foot the bill for the cleanup. So just as you know, I always try to give you a little bit here and there. Well, there's your bit for the day. If you're working with somebody who's looking to do development, is working with a toxic waste site, they can get brownfield funding to help clean it up. So buyers may have to be responsible for cleanup costs. If, and this is a big if, there's federal dollars involved in a subdivision or building. Whenever there's a federal project that requires federal monies, then an environmental impact statement must be developed and presented to the planning board as part of the application, which means they send scientists out into the field to investigate the various animal and plant life, the micro environments and habitable environments of certain animals to determine what effect this new development will have. And if there are no major impacts, then there's no problem. But they may identify an endangered species of spotted horny toads or something. And if so, then you may not be able to develop, or you may have to relocate those special protected animals to a specific area at great cost. But this is all required when federal dollars are used in any subdivision or development of property. All right, moving on. New Jersey environmental regulations, #1, developers and builders. Consult before you buy and before you build. Earlier, I had made reference about working with developers and builders, and if I knew what the master plan was, I would have a leg up in helping them get their project approved. Well, here's the other thing, guys, and I also made mention of this. Let's say you identify a property that has the potential of subdivision or to be built out for greater value. And you tell your builder about it, and he says, I'm interested, I'm in on the project. Well, what I would do is I would come before the seller or owner of the property and propose a purchase of the property. If I got their agreement, we would sign a purchase agreement subject to the buyer getting approvals from the planning board to build his project. He's not buying the property blindly. He's going to buy it if he gets approval from the planning board. But if he doesn't, then the deal's off. So always consult with professionals about usage, about allowances, about possibilities, about master plans before you buy and before you build, because once you buy and they say no, then you're stuck. So find out this stuff before it goes down. And also, always determine if the site is regulated by the Division of Land Use Regulation, the master land use control laws that are on the books. And if so, what are the rules for that property? Look them up. Tell your builders and developers so they know how to treat it. Now, there are certain protected environmental areas in New Jersey. Yes, I am going fast, and no, I'm not stopping for questions right now. I got to get this in before the end of the day. One of those protected classes is the Highlands Water Protection Planning Area. Excuse me, I mentioned this before, where it protects New Jersey drinking waters by preventing overdevelopment in areas surrounding those protected drinking water places. Now, this Highlands Water Planning and Protection Act is located in the western part of Bergen County, specifically on the western slope, the western edge of the Ramapo River in Mahwah and Oakland. I live in the Highlands Planning and Protection Area in Oakland. It goes westward all the way to Delaware River through Passaic and Sussex County, down to Warren County, comes back into Somerset County, and it's huge. It's and Morris County. And there's 6 reservoirs at minimum that are in these areas that are protected by the Highlands Protection Act. There's the Wanacue Reservoir and the Monksville Reservoir. There's Green Pond Reservoir and Canister Reservoir. There's Echo Lake Reservoir and Boonton Reservoir, all of which are owned by the Newark Water Authority, of which 5 million New Jerseyans get their fresh drinking water from every day. What would happen if overdevelopment were to cause a pollution to occur in these drinking waters? Where would 5 million New Jerseyans get their fresh drinking water? Very tough decision to have to be considered. So the Highlands Water Protection Act, Planning Act, was incorporated in 2004 that said, if the land has not been subdivided as of 2004, it may never again into perpetuity ever be subdivided again. Therefore, it limits the growth of building and development because of that. Another protected area is the New Jersey Pinelands Protection Act. It encompasses 22% of New Jersey's landmass, including historic berry farms. There's old towns. There's a state park, Allaire State Park in this area. Down South Jersey, they needed a way to protect these pine lands from overdevelopment, because back in the 60s and early 70s, developers down around Toms River, specifically on Route 70, went out and started to clear cut thousands of acres of property. Just clear cut them as far as the eye can see, just denude the land of all trees and brush, just dirt. And then they came in and they built retirement communities. There's Leisure Knoll, there's Leisure Village, there's Leisure this, there's Silver City this, there's Retirement Community X, there's Retirement Community Y. They're all over down there. So they had to find a way to protect that area from the constant overdevelopment from the developers' saws. So they enacted the New Jersey Pinelands Protection Act that said if anybody wants to redo any development, not only do you need your municipality's permission, but you need the Commission for the New Jersey Pinelands Protection Act to approve your development as well. And if the pinelands say no, then you cannot develop. There's the New Jersey Wetlands Act, originally of 1970, that said anytime a builder or a developer identifies a wetland, then you're not allowed to build within 75 feet of that wetland. The Wetlands Act was reauthorized in 93. It's not in the book, it's not important, which says now when you identify a wetland, you can't build within 300 feet of the wetland. So naturally, my question is, how did Harmon Cove get developed? How did the American Dream, formerly Xanadu, get permission to be developed? That's within 300 feet of the Hackensack River, a known wetland. The only thing I can surmise is that there may have been some shinola exchanged between somebody or something, and then permissions came out of the blue. But again, I don't want to speculate too heavy on that. So the wetlands require permits and special permitting to build, excavate, or do any type of development whatsoever in a certain area. And it covers both coastal areas and inland freshwater areas. There's the Coastal Area Facilities Review Act, known as CAFRA, which, according to them, along these coastal areas, which encompasses anywhere from the Atlantic Highlands inside the Sandy Hook, up and around Sandy Hook, all the way down around Cape May, and almost halfway up to Trenton, because that's all oceanfront property, believe it or not. So if you're going to be developing communities in those areas, you have certain guidelines you must adhere to. Clustering, planned unit developments must be incorporated to preserve space and open air. So the Coastal Area Facilities Review Act is important for developers to understand how they can build and where they can build in these areas. There's also the Waterfront Development Law, which regulates outside of the CAFRA area, and DEP approvals must be garnered for any waterfront developable lots on any navigable waterway or stream. And after Hurricane Superstorm Sandy came in, FEMA redrew all of the flood maps. So what was not in a floodplain is now in a floodplain. What wasn't in a floodplain what is in a floodplain is now no longer in a floodplain. It's weird the way they redrew these maps. But under the Waterfront Development Law, all this stuff applies to building and reconstruction of houses. So if you live in this CAFRA or waterfront development area and your home is damaged by storm, then if 50% or more of the home was damaged, it must meet now all new code requirements of being elevated on stilts, with the first floor no closer than 1 foot above the highest recorded tide area, which adds about an $80,000 building cost to rebuild that house. And since most people don't have the extra $80,000, they just don't rebuild their lots and leave a pile of wood where a house used to be. But those who can't afford now have to rebuild their house up on stilts. Many different laws are incorporated here. New building codes were created because of the Waterfront Development Law, including after Sandy, the use of hurricane clips in the building of residential and commercial properties. If you never heard of that before, if you're from Florida, you know what I'm talking about. It's like a joist hang or a metal bracket that attaches the sidewall to the roofing trusses and braces. That way, if a big wind comes, it doesn't blow the roof off. It's that easy. So building codes change as a result. There's also the Interstate Land Sales Full Disclosure Act, which regulates any development of 25 plus units. And the developer has to file a statement of record with the New Jersey Real Estate Commission and the Consumer Financial Protection Bureau. It protects the public from unscrupulous developers and marketers and from undue sales pressure. If you buy property under the Interstate Land Sales Full Disclosure Act, you may have as much as 7-day right of rescission to cancel the contract. So under the Bureau of Subdivided Land Sales Control, all out-of-state properties offered for sale in New Jersey must be registered with the state of New Jersey and are substantially the same as the Interstate Land Sales Full Disclosure Act, where buyers can cancel contracts up to 7 days after the original purchase. And if they are advertising a language other than English, then all their subsequent forms must be available in the same language that they're advertising in. Now to go into the final stretch here, guys, the home stretch. Building regulations. There's the Uniform Construction Code, the master Bible of all tradesmen for construction. If you're an electrician, there's rules and regulations about what materials you can use and how you can use them. If you're a plumber, the same. If you're a framer, the same. Any trade in New Jersey is required to abide by the Uniform Construction Code. Your local building department is very versed on the Uniform Construction Code and may have additional code regulations. So a builder, developer, contractor needs to know what the UCC codes are as well as any local municipal codes. If you're a builder of new homes, then you must provide the purchaser of your new home a 10-year warranty on structural items. New Jersey requires all new buildings of residences, all new builders, to provide the buyer of a newly built home a 10-year warranty on structure. Required. Another term in the building regulation is construction permits. In order to do renovations in a house, when I did my kitchen, I was going to rewire the kitchen, so I needed an electric permit. I had to rewire the plumbing to add a water line to a new fridge location, plumbing permit. I removed a wall, put a micro lam in the roof to support the load. I needed a structural permit. So building permits are ways that a code enforcement official can have knowledge of what you're doing, come and inspect what you're doing, and if everything meets the UCC, Universal Construction Code regulation, he closes the permit out and gives you a certificate of occupancy to habitate. If it doesn't meet the codes, then he doesn't close out the permits and no CFO comes. So contractors need to know what these rules are. So the UCC regulates construction, alteration, renovation, and occupancy of all buildings. The existing buildings don't have to conform to new rules except if repairs of 50% or more of the value of the building has to take place. Then the entire building now must meet all the new code requirements, the entire building. However, if the alterations are only between 24 and 50%, only the new part of construction has to be code compliant. The old part doesn't have to comply. And that's why you see renovators leaving one wall standing when they regut a house. Because if they leave 25% of the original structure, one wall, then it's a rehab and they don't have to pay new construction and new code requirements for the entire building. So there's a reason to this madness. As I said, excuse me, all new homes must come with a 10-year warranty. And construction permits have to be issued before any construction, alteration, demolition, or change of the use of the building can be undertaken. Now, a lot of people say you don't need certificate, the building permits. I'm going to talk on a different day about why you do, but it's very important because it helps the building officials understand what you're doing and inspect to make sure that it's safe. If you didn't get building permits and you did the project anyway, and if you don't know what you're doing, people can die. And I'm being very serious. So I know people say you don't need permits. I'm going to tell you right now, sometimes you really do need permits. So just be aware of that. Now you get a certificate of occupancy when the building meets all the code requirements, or if you're living in a property and doing renovation, you can get a certificate of continuing occupancy to allow to live there while renovations are taking place. Now, smoke detectors must be located on every level of a building. It must be the new style in New Jersey, 10-year sealed battery compartment units. You must have carbon monoxide detectors on every level of the building, and they must be the same 10-year sealed battery compartments. And at least one of both of those must be within 10 feet of any bedroom. New Jersey also requires that be working portable fire extinguishers in every home. Therefore, there must be one minimally attached to a wall-mounted bracket in a kitchen location. That's a requirement by code. And finally, there's the hotel and motel dwelling health and safety laws that govern larger habitable buildings like motels and hotels. Therefore, it's enacted to ensure that when residents occupy, they have a decent standard and safe units of the dwelling space they occupy. It applies to anything with 3 or more units, hotels and motels with 10 plus or more units of dwelling of the space of sleeping facilities, and for 25 plus persons. All these laws apply for these reasons and applications. So it's almost 4 o'clock and I finished the chapter, and I know you have questions, guys, but I'm going to go right to the chapter review. We're going to go through it, and I'll leave it open after that if there's questions. So let me pull this up for chapter 18 and start the review, because everybody, I know I do, I want to get on the road before this storm hits to get out of here. So number 1, a person who buys farmland near the city and turns it into a building lots is any person who buys farmland near the city and turns it into building lots is now you got it. I see those answers changing. All right, from those responding, 67% of you are correct, answering D, a subdivider. Yes. Number 2, overall subdivision regulations or guidelines are set by Three chapters in a day is a lot, guys. It really is. I know that. I know it's a lot. And I'm not asking you to do anything any other class hasn't done. It's just that this is the way sometimes it goes. We have to get a lot in one day. Overall subdivision guidelines are set by B, the New Jersey Municipal Land Use Laws of 84% of you got that correct. Good job. Number 3, local governments often regulate subdivision through their, which department? And from responses I received, it looks like 87% are correct, answering A, planning boards. Yes, indeed, it's the planning board who regulates that stuff. Number 4, a particular subdivision plan may require the services of and 88% of you are correct. D for dog, all of the above. Yeah, probably required service of all those guys. Number 5, a map illustrating the sizes and locations of streets and lots in a subdivision is called. It's a funny sounding name, right? And from those who have responded, 67% of you are correct, answering C, a plat of subdivision. Yes. Number 6, which of the following items are usually not designated on a plat for a new subdivision? Oh, the weather outside is frightful. Oh, I'm sorry. And 90% of you are correct in answering D. Prices of residential and commercial lots are not on the plat plan. Number 7, a subdivider turns over streets to public ownership through, what's the term I used? A gift of private property to a public entity is known as a. And 60% of you are correct, answering C. Dedication is the term used of a gift of private property to a public entity. Number 8, deed restrictions are usually placed on an entire subdivision by the. We actually talked about this last week, if you recall. Who can place deed restrictions on properties? Either the seller or the. And from those who responded, 50% of you are correct in answering D. The subdivider can create deed restrictions on properties. Number 9, which of the following would not be a part of the development cost of land? And 44% of you are correct answering C, the raw land cost. That's an acquisition cost. The development cost is plowing, clearing, putting sewers in, but acquisition cost would be buying the land. Number 10, gross density refers to which of the following? Okay, there's a trade-off here. Now it's shifting. Let's see what we got. Gross density refers to which of the following? And 57% of you are correct answering B for boy, the average number, maximum number of houses per acre that may by law be built in a subdivision. 11, the longest a new home builder must warranty some parts of the construction against defect is new homes. What's the length of the warranty on new homes? Okay. 83% of you are correct answering D, 10 years. Correct. Number 12, in New Jersey, subdivision regulations may apply as soon as anyone splits off the 'And unfortunately, the majority of us got it wrong. The answer is B for boy, the second lot. As soon as a second lot is created, a person is then a subdivider. Number 13, a builder found a buyer for a new ranch home he had just finished, but the buyer needs occupancy right away before their mortgage loan comes through. Before letting the buyers move in, the builder must obtain 91% of you answered correctly. B for boy, the certificate of occupancy. Well done. Number 14, multiple dwelling are inspected by the state every 5 years if they have at least, and I brought this up in another chapter. It's in this chapter. I didn't reiterate it today, but how many units are required for the state inspection for every 5 years? How many minimum units? And 35% of you correctly answered B for boy, at least 3 units. Remember, the Department of Community Affairs inspects anything with 3 units or more every 5 years. Number 15, a subdivider can increase the amount of open net or recreational space in a development by doing what? And from those who did respond, 75% of you are correct answering C, clustering housing units to give more open space consideration. Number 16, in New Jersey, New Jersey, which projects are obligated to provide an environmental impact statement. Sorry about the typos, guys. In the book, it's very clear. In New Jersey, which projects are obligated to provide an environmental impact statement? And from those responding, federal projects, 30% of you had federal projects correct, require an environmental impact statement. Number 17, about 22% of New Jersey's land area, including historic villages and berry farms, is protected by the And from responses, 75% of you are correct, answering A, New Jersey Pineland Protection Area. Correct. Number 18, the owner of a owner of a home built in 1925 suffered extensive damages during recent high winds and hail. The insurance adjuster estimated that more than half the building would need to be rebuilt. Under the Uniform Construction Code, what is the status of making repairs to the existing building? And from responses received, 2 out of 3 of you, 66% answered correctly. C, the entire building must now meet the latest code standards. Number 19, no new or altered buildings in New Jersey can be used or occupied until the local construction official issues a and 85% of you got it correct. C, a certificate of occupancy, C of O. 20, all builders of new homes must provide a what? Excellent. 87% of you got A. Warranty against defects for varying periods up to 10 years is correct. Number 21, in New Jersey, what is required by the Uniform Construction Code before any construction, alteration, demolition, or change of use of building can be undertaken? Boy, lots of typos. We'll have to correct those. And from responses received, I'd say a good 87% got it correct. C, construction permits. Yes. 22, New Jersey requires the broker who sells out-of-state subdivided land to, now I didn't go over it, it's in your textbook, but I'm going to give you the answer. A, register with the state. A. Number 23, in New Jersey, the buyer who purchases out-of-state subdivided land may cancel the contract for no reason within how many days? Yes, you know it. There is a right of rescission up to 40% are correct, answering B, 7 calendar days. And the 24. A developer advertises property for sale in Vermont to New Jersey residents. The advertisements are all in French. Any additional forms, contracts, or other materials that are made available to prospective purchasers must be in and a good 35% of you were listening. B, French, has to be in the same language it's being advertised in. And the last question for the day. In New Jersey, real estate brokers may need special registration when selling some Yeah, you guys got it. You know this stuff. Excellent. 70% of respondents gave me the correct statement of A, out of state properties. A is correct. Real good job, guys. We were under time constraint, but we got it done. Now, I will stick around for a few minutes for any after school questions, but for the rest of you, you met your obligations. Thanks for sticking with me, guys. If anybody has questions, chapters 16, 17, 18 for homework, Miss Cora will go over with you tomorrow if she's leading class. If I'm here, then the storm wasn't as bad as it's supposed to be. But if I'm not, then hopefully you guys make it safely through the storm, and I will see you again on Friday, in which time it will be a review. So for tomorrow, please read 19, 20, and 21 and prepare for your class. So if Miss Cora is coming in, she'll say, boy, Tim's students are so smart. I'd like to hear that. But anyway, I hope you guys have a great night. Batten down the hatchings is going to be a tough one. I hope you make it through. If everything's good, the good Lord's willing, and there ain't no emergencies, we'll see you again on Friday, guys. Have a great night. And if you have questions, stick around. If not, have a great evening. See you guys. Okay, let's see. The answer for 23 and 25 for Unit 18 are wrong. 23 is D, 25 is B, according to the book. If that's correct, then the book's wrong. I gave you the correct answers. All right, Tim, thank you for this classes. Today is my final class. Congratulations, Brian. Good luck to you. All right. What's the answer? Number 9 was C, raw land cost. Is converting a single-family home into multiple families considered subdivision? No. You have to get permits first and rezoning of the property, most likely, but it's not subdividing. Subdivision has to do with the lots, not the actual building. Oh, good. Thank you, William. Appreciate it. I know it was a tough one today, but I'm glad you made it through. Welcome to the club. All right. Have a good night, guys. Okay, Vanessa, good luck to you. Good luck to you. Thanks. Appreciate it. All right, guys, anybody have a question? Let me know. If not, then let me go. If you love me, let me know. If you don't, then let me go. All right, guys, have a great evening. Was there any last-minute questions before I wrap it up and put on my chains and try to navigate through the storm hole? Thanks, Mohammed. Have a great night. All right, guys, I'm not seeing any questions, so I'm out of here. I hope everybody has a safe evening. Hopefully see you on Friday. Have a good night.